good day, ladies and gentlemen, and welcome to the show. Glad to have you guys here. Monday, the 15th of March, 2021. Thank you for tuning in. Now, over the next couple weeks, I'm half expecting a crash. And there's one sole reason why I'm expecting this. Is the debt markets. The U.S. 10-year, to be more specific. It's been rising and rising, and they're not really doing anything to stop its rise. Now, what it does, it'll rise up to a new level, and then it'll fall back. It's been doing that all along, And, well, let's get in there, and let's open up the charts right here and take a look at this. We go to bonds and rates here, and we'll go to the U.S. 10-year. Glasses are all fogged up here. Here we go, 10-year right here. Okay, it's at 1.616 right now. But what we're going to do is we're going to focus in on this chart right here. Pull it over. No, that's the 1 year, what it's been doing for a year. See, it just goes up and up. But if you watch this, if you look at it closely, what you'll see is it goes up to a new level and it falls back. Goes up to a new level, falls back. It's been following this pattern for a long months and months and months and months and months. There's no reason to expect it won't continue following this pattern. Right now, we're in one of these little fallbacks where it's falling back a little bit. Maybe if we take a look at the 3 months and take a look, and you can see this better. Right now, we're in one of these little patterns where it's falling back, and then it'll bounce back. Well, when it starts to get up around 2%, they can't take it. In fact, if it gets up to like 1.7, 1.75 maybe, the markets will start to turn over. Really. The Dow, everything will start to fall in price because the system is already deflated out in the general economy. Just go to your local shopping mall or whatever. It doesn't matter where you are in the world. London, Paris, New York. Look around you. The system has collapsed. But the financial system hasn't collapsed. So we got the general economy, which is in a state of collapse and in a state of it's just horrid what's happened to it. But the financial economy is booming out there, and the market's going up all the time, higher and higher and higher. But the market cannot withstand these high interest rates. The system cannot withstand them now. And, if we were to go back 20 years ago and look at 1.61%, we'd say, oh my goodness, that's low. That's crazy low. That's not a normalized rate. But right now, we're in a system that can't even withstand anything that approaches or slightly over 2% on the U.S. 10-year. Just can't stand it. And so we've had this little bounce back down a little bit. Everything's okay right now for the moment. But if you look at the chart, you can see that this bounce down, this lowering of the rate is only a temporary thing, very temporary. And in a few days, it's going to bounce back, and it's going to probably head up toward 1.7 or 1.75. We're going to, at some point there, between here and 2%, I'm expecting the markets to roll over. And when they roll over, because they're so over-leveraged, they're going to roll over really fast. It's going to be frightening how things roll over. This is just the way things work in the financial system. When things get too over-leveraged like they are now, they have an awful lot of pressure to the downside. And now we've got computer trading, and you've got all these computer algorithms running the market and everything. Things can happen at the speed of light. 26.15 today for silver. It's up 22 cents on the day. So silver's looking strong right now. It's on the high side of its new range itself, set for itself. Let's take a look at gold. See what gold's doing. 17.28. It's up 10 cents on the day so far. I mean, yeah, 10 cents. Is that all? That's nothing. But anyway, it's up a little bit. So we'll take whatever we can get. 1728 for gold. Uh, Now let's take a look at crypto. Now crypto last night was getting up really high. It was up to like 1830 or 1840 in billions on the industry, and we were looking at a Bitcoin price that was over 60,000. I think it made it up to like 61,000 last night. Now it's back down to 56,000 for Bitcoin. So it's had a little drop in price overnight. Uh, Looking at all these coins, when Bitcoin goes down, they all go down. They all follow Bitcoin. Bitcoin is like very much for these cryptocurrencies. Bitcoin is like the US dollar, being as it's the world reserve uh, currency, fiat currency. It's a world reserve fiat currency. Bitcoin is the world reserve alternative asset cryptocurrency. It's a world reserve cryptocurrency. That's what Bitcoin is. And so it's the number uno in the cryptocurrency industry is Bitcoin. It's the elephant in the room. Makes up well in excess of 50%, like 60% of the market, the whole market share. But you know, the dollar does the same thing in the fiat world, you know. But there's a huge difference between Bitcoin and the dollar. Boys, I'll tell you. You know, Bitcoin, it could act like a black hole and swallow up the world's financial system if they don't stop it. Now, you know, the thing is will they stop it? I'm not so sure. So it just might swallow up the world's financial system. You see, they're looking for a hedge against the dollar, you know? And buying real physical gold can be very, very difficult, you know, and that's Bitcoin's the only competition out there for Bitcoin is gold. And the same thing with gold for Bitcoin, you know, but the thing is buying Bitcoin is just so easy. And the financial system, with its instability right now, they're looking for stability. You know, and the whole thing could start shifting really. This whole thing could actually happen so fast, guys. I know it's taken years to get here. And you watch me on my channel for years talking about hyperinflation and everything else. But all the dominoes are there ready to go now at this point. It just takes a loss of confidence, which we're already starting to see happen, and the confidence in the dollar is being eroded daily. And then a massive price increase in these alternative asset classes and stuff. And people to actually see when they go to the store, that pair of shoes that they went and looked at last week that was like $84, now they're $184. And, you know, people are going to say, hey, you know what? I ain't saving no more. It's just a consensus that goes out there amongst the general population of the world. It's a change in attitude that can happen so fast, you know. And okay, we got this little roller coaster happening right now in the stock market. Stock market might fall off and things might get deflationary, but then they'll come in and they'll pour in money into it and get it going up again. It'll go higher than ever, and they can't stop. If they stop, the whole system will completely crash to the ground. They would lose power. They can't let that happen, so they're going to have to keep pumping it. And the thing is we're heading toward a default right now. The default can come in two ways. One, they can just not pay. They can not print. And the system will go into default. Everything will go bankrupt. Or they can default in a secret way, which is called inflation. And this is a tax. And it's also a default on the fiat currencies. And that's the way they're going to go, because that's the way they have to go. And it can happen awful fast once it happens. Anyway, let's go on. Let's move on and take a look now at the Dow Jones Industrial Average. You know, I've been saying we have until 2023 before we get the hyperinflation. It could come sooner. I mean, don't write that in stone and say Glenn said 2023 and the hyperinflation's happening right now and he said 2020. Well, yeah, it could come sooner. It's an awful hard thing to actually forecast the actual occurrence of this event, because this event is something that happens with the people. When the people become insecure about the dollar and they say, hey, I'm not holding these dollars anymore, I'm going to go out and spend them. It's a loss of confidence in the purchasing power. That's what it is. And I can see the roots of that starting to swell. People are starting to lose confidence right now, but it hasn't really got there yet. And I'm thinking it'll probably be around 2023, and I have a number of reasons why I think that, but it might come sooner. That's what I'm trying to tell you guys. So you guys start preparing for this, because if you're not prepared, you're not going to make out very good. Let's just put it that way, And you say, well, how do you prepare for something like a hyperinflation? Well, the first thing you do is you buy assets that are going to move in the opposite direction from the fiat currencies. Fiat currencies are going to go down in flames. First thing you got to do is buy alternatives to those fiat currencies. And there's three alternatives out there. There's cryptocurrencies is an alternative. Gold is an alternative. And silver is an alternative. Copper is an alternative. Yes, you can buy copper. For a poor man out there, if he can't afford silver even, you can buy copper. And copper is I would almost list it as the three precious metals, gold, silver, and copper, because they used copper as money for so long. Right up until they started, I think the United States, do they still have pennies? I'm not sure. They might get rid of, I know they got rid of the penny here in Canada. That was the copper coin. Copper was money. So, yes, you can use copper and other metals too, like metals like aluminum. Maybe a guy's got a big scrap pile full of aluminum. That's money. When the dollar goes down to nothing, that's money. So metals are money. Most metals are money. If you got a big enough quantity, even steel. If a guy's got a big mountain of steel in behind his house, he will do rather well through the hyperinflation that's coming. It's all going to go up in value while the dollar goes down, because the dollar's not worth nothing. What is it? It's a piece of polymer. It's not even paper anymore. You can't even use it for the uses paper has. At least you can light a fire with paper, or you can use it in the outhouse, But you can't do nothing with this polymer. These polymer notes. What can you do with them? They're not even good to burn. The smell that comes off of them would be toxic. They're useless. They're confetti. That's what they are. And they're going to turn into confetti. Okay. Crude oil today. $64 today for crude oil. It's down a little bit. Down 121. That's quite a little bit. 1.84%. Move index today. And now we're watching the move index. It's creeping up into the 70s. And I told you guys, 75 is my mark I've put on it, that says that instability is beginning. It can go up a lot higher than that. It can go up to like 120. And it can shoot up really fast when there's instability in the credit markets. This is why we watch this move index like a hawk, because the Fed watches this like a hawk. This is what motivates the Fed, into action. It was languishing down here in the 40s, and now it's up to the 70s, and it's climbing. Let's take a look at the U.S. 10-year today. It's at 1.61%, but we're going to shift back, and we're going to take a look at the whole yield curve, and we're seeing that the long end is falling yields today. That takes some of the pressure off, see? But you just know, in a few more days, these are going to go boing. These yields on this long end is going to jump again, unless the Fed does something. And if they just sit there waiting, and they're sitting there hoping, because they do not want to do yield curve control, because they know that'll be the last straw. We're off to the races on hyperinflation once they do yield curve control. And they know it. And so, if they don't do yield curve control, this whole system's going to deflate. The opposite of hyperinflation. It's going to all deflate. So this is everything. Right here. This is everything. This is the deflationists out there. This is their last hope. They're hoping that the Fed's not going to do nothing and let these yield curves go up higher and higher and higher until the whole system deflates. And they're sitting back and they're saying, I'm all in dollars and I'm ready. I got all my dollars stacked in a row and I'm ready. Let the Fed do it. Let the Fed sit back there and let these yield curves go out of control and let all the markets crash. Let the Dow crash by 80% and all this kind of stuff. Well, don't just sit there and say you're ready for that. Because if the Fed did do that and the markets all crashed by 80% and everything else, do you know what our world's going to look like? Everything's going to go bankrupt. You just might, well, your dollars might not be worth anything anymore because everything will crash right down to a stop. And where are you going to spend them? You got to think about things before you wish for something to happen. I don't think the Fed's ever going to do that. They're going to do something at a certain point, but they never react. The Fed never reacts until they're forced to react. And so I can see what probably will end up happening is these yields will get up around 2%, and we're going to have a little a market crash like we had back when, and back around March of last year, a little market crash like that. And then the Fed's going to come rushing into the rescue with yield curve control. Once they do that, it's game over. And all these things they got going on, like these $2 trillion here and $1.9 trillion there, and these new expenditures. You know how they're deciding to pay for it? They're just going to raise taxes. Well, that's a zero-sum game. You raise taxes, you basically crush your taxation base. That's a zero-sum game. That ain't gonna do it. That ain't gonna cut it. But it's gonna make it look good, making it all look good on paper and everything, U.S. dollar index today, 91.83 on the U.S. dollar index. It's got a slight upward tick to it, but it's kind of going along sideways a little bit today. Thank you guys for listening to my show. Like and subscribe. And don't forget to hit that little notification icon. And keep the comments coming in the comments section. And we'll catch you guys in the very next show. Bye-bye.